This video covers accounting for long-lived assets. I'll define long-lived assets. We'll talk about how we depreciate long-lived assets. Assets lose their value over time. When they lose their value quickly, we might have to impair our long-lived assets. We'll learn about impairment. Sometimes we dispose of long-lived assets. We sell them. We'll learn how to account for that. And we'll go through a disclosure example using Target as our company. First, let's define long-lived assets. Long-lived assets can be tangible or intangible. Tangible means you can knock on them and it makes a noise. Intangible is something you can't really touch, like software or a patent. These long-lived assets must be expected to provide material economic benefits to the company. Material is different for every company. Large companies, it has to be a pretty big asset before it qualifies as a long-lived asset. Smaller companies, even small things like chairs, qualify as long-lived assets. It has to have material economic benefit to the company for at least 1 year. So a long-lived asset has to have a useful life greater than a year. Let's look at an example. And the example we'll use is a treadmill desk. Suppose our company is going to buy a treadmill desk, and I don't think you can get them for $350. So let's just assume we're getting it from eBay. It's a used treadmill desk, and it's $350. First, we have to decide whether this qualifies as a long-lived asset for our company. So we'll go through 2 questions. First, does this treadmill desk have a useful life greater than a year? Suppose we think it does. In fact, we're going to think it has a 3-year useful life. So we're going to put a check mark. Yes, it does. The second question is the cost greater than whatever our threshold value is for what qualifies as a long-lived asset? Suppose we're a small company, and so we've set a threshold of $300. So if we purchase something that's greater than $300, we're happy to put that on our balance sheet rather than expensing it right away. So we'll say this treadmill desk meets both criteria. Here's the journal entry we would record as long as we're treating it as a long-lived asset. It's a debit to an account called PP&E, Property, Plant, and Equipment, which is an asset account. It's on the balance sheet. We would debit that account for $350 and credit cash since we're paying cash for $350. If we said no to either of these, then instead of PP&E, we would have debited some expense account. On the income statement. So if it doesn't qualify as an asset for us, we're not going to tell investors about the asset by putting it on the balance sheet. We're just going to debit an expense account on our current year income statement saying, hey, this is just a cost of business this year. You don't need to think of this as an asset going forward. It's not material enough for that. Or its useful life is going to be used up this year. So that would be the alternative. So if no to either of those, then you would just debit an expense account. You'd still credit cash, but you'd be debiting an expense account. Now let's talk about how to depreciate this asset. So we're going to be walking on this thing on a daily basis, and it is surely going to depreciate. We need our accountants to estimate what is the nature of the depreciation. So depreciation means that the asset loses its value over time. And the way almost all companies account for depreciation is by using the straight line method. And so here are the estimates we need to compute straight line depreciation expense. We need the acquisition cost, which was $350. We need to know its useful life. How long are we going to be walking on this treadmill desk until we're done with it? And that estimate is 3 years. Then we're going to need to know its salvage value. So at the end of 3 years, how much do you think we can get for this thing? That estimate is $50. Taking all these estimates, we can compute how much depreciation expense we need to record every year. We take the acquisition cost of $350 and we subtract the salvage value of $50. And that's in a numerator. So the numerator here is $300. That's because while we're using this asset, it's going to depreciate by $300 over its 3-year useful life. How much depreciation expense should we take per year? Well, in that case, we need to divide by 3 to get $100. So if we depreciate this asset by $100 every year, after 3 years, its accounting value will be down to $50, and that's perfect. So that's what we'll need to record as depreciation expense each annual period. Let me show you how to do that now. So I'm going to assume we acquired this asset on January 1st, 2020. That's the same journal entry you saw on the previous slide. After a year goes by, it's December 31st, 2020, so we've been walking on the treadmill for a year. Using the straight line method, it's depreciated $100 now. We need to take $100 off of this asset's book value. We do not reduce the PP&E account directly though. We introduce a new contra asset account called accumulated depreciation. Accumulated depreciation is a contra asset account, meaning a typical asset has a debit balance. This account has a credit balance. And just like the allowance for doubtful accounts was stuck to the bottom of the accounts receivable account, the accumulated depreciation account sticks to the bottom of the PP&E account, reducing the $350 acquisition cost to its net book value of $250 since 1 year has gone by. So if you take that debit and that credit, its net book value is $250. Over the subsequent 2 years, it depreciates in a straight line, meaning we record the same amount of depreciation expense every year. This depreciation expense account is just a typical expense account. It shows up on the income statement. And it gets cleared out every year into the retained earnings. So let me show you what our balance sheet will look like with all these journal entries. Here I'm presenting a balance sheet for 3 years in a row. At the beginning of 2020, that's when we acquired this treadmill desk for $350. Here is the balance sheet at the end of each year. So the end of 2020, the end of 2021, and the end of 2022. You can see that this PP&E account, which is a debit, is just maintaining at $350. The accumulated depreciation account, which is a credit balance, is accumulating the depreciation. So it's $100 after 1 year, it's up to $200 after 2 years, and $300 after 3 years. The book value, this is called the book value. If you take gross PP&E and subtract accumulated depreciation, you get book value. It's reducing by $100 each year. So after the first year, the book value of our treadmill desk is down to $250. After 2 years, the book value of the desk is down to $150, and after 3 years, it's down to $50. Next, I'll show you what the income statement looks like over these 3 years. Recall that we just charged $100 to depreciation expense each year, and so that's all that appears on our income statement. 3 $100 charges, 1 per year. And it shows investors for any given year, how much did it cost you to own that treadmill desk? Well, each year we own the treadmill desk, it costs us $100. That's what the income statement tells you. And each year that depreciation expense account is cleared out and closed into retained earnings. So it starts back at 0, ready for the next $100 charge in the next year. Our next point, we'll talk about impairment. So here we're stopping at the end of 2020. This is after 1 year of ownership of this treadmill desk. We're going to look at that book value. Remember, this is the book value. And we ask ourselves, do we need to impair this book value? Is this treadmill desk really still worth $250? Or has it really lost its value? Maybe it was used and we totally broke it. Then it's not worth what it was anymore. In that case, it's not fair to tell investors we have an asset of $250 if it's just a heap of metal in the corner of the office. So we need to do an impairment analysis. Here's how we do it. Remember, the book value was $250. What we need to do is do a cash flow forecast as of the end of the fiscal year. So it's December 31st, 2020. We've had the treadmill desk for a year. Its book value is $250. The question is should it still be on our balance sheet for $250? So what the accountants will need to do is think, how much extra cash is our company going to generate because we have this treadmill desk? That is the basis of the treadmill desk's value to the company. Because I am walking while I'm doing my work, maybe I can do more sales, generate more revenue, and the company will have extra cash flow. That's the idea of this treadmill desk representing an asset. So how beneficial is it to have this treadmill desk? Accountants will prepare a cash flow forecast. This treadmill desk, we're so happy we have it. It's going to produce $100 next year, $100 the year after. We're going to sell it for scrap metal of $50 in the third year. So the total cash flows we're expecting to have for this treadmill desk is $350. But a finance person will say, well, that's the cash inflows, but what is the value? Because $50 3 years from now surely isn't worth the same as $50 today. So the accountants will do a process called discounting, and we'll learn more about this in the bonds lecture. But we have to discount these cash flows. $100 a year from now might only be worth $90 today. $100 2 years from now might only be worth $82 today. And $50 3 years from now might only be worth $38 today. Don't worry about these calculations yet. The key is that what we're coming up with is the fair value. If we were to sell this treadmill desk, $210 is what we would expect to get for it. Because whoever's buying it is expected to, well, I think if I'm buying the treadmill desk, I'll get $100 next year, $100 the year after, $50 the year after. What's that worth to me today in today's dollars? Well, I'll discount those cash flows and come up with $210. So $210 is the fair value. So now we're doing the impairment analysis. We've produced the undiscounted cash flows here, undiscounted, and the discounted cash flows here. Here's how the accounting rule works. First, you start here. Take the sum of your undiscounted expected cash flows. Is it less than the book value of the asset? So let's go back. The sum of our undiscounted cash flows is $350. Is $350 less than our book value of $250? No. $350 is greater than $250. So we're going to go down the no arrow. And we do not have to record an asset impairment. That's our scenario. How would we get down the yes line? Well, let's take a look. Let's change our facts a little bit. Let's suppose instead of $350, we get down to $100. That's a dollar sign. And instead of $210, well, let's say this is only $50. Okay? So let's say these are the numbers that we're dealing with. Is $100 less than our book value of $250? Yes. So we would be going down this line. Then you would need to record an asset impairment. You'll need to write the asset down to its fair value. So our new fair value is $50. So we need to write our $250 asset down to $50. That's a $200 impairment, and here's how we would record it. It'd be a debit to depreciation expense and a credit to accumulated depreciation. $200. This is the same depreciation expense journal entry that we did before. Now we're just accelerating depreciation because this treadmill desk really isn't worth what it used to be. Our straight line depreciation wasn't fast enough. So we do this catch-up entry, a debit to depreciation expense, a credit to accumulated depreciation, to write down the asset's book value to its fair value. So we're writing down this $250 down to $50. Next, we'll talk about disposal of an asset. So again, we're stopping 1 year after we bought the asset. Its book value is $250. And now we want to sell it. It's really not working out. My feet hurt. I'm done. I want to sit in a chair. Let's sell this treadmill desk. Its book value is $250. How much can we get for it? Let's talk about two scenarios. The first scenario, we can get $500 for it. Treadmill desks are in fashion. Everybody's working from home. So everybody wants a treadmill desk. We could sell it for $500. What's the journal entry? Well, we're getting $500 for the desk, so we debit cash $500. Next, the important step is we need to remove every trace of this asset from our balance sheet. We need to remove its acquisition cost, which is sitting in the PP&E asset account. So credit the account for $350 to remove that from the account. We also need to remove its accumulated depreciation. Remember, we have $100 of accumulated depreciation. So we need to record a debit to that accumulated depreciation contra asset account. Remember, it's sitting with a credit of $100. So when we record this debit of $100, it cancels out and it's gone from our books. So step 1 was to recognize the cash as a debit. Step 2 was to remove all traces of the asset from our book. Step 3 is to balance the journal entry. The debits are $600, the credit is only $350. We need another credit of $250 to balance this journal entry, and that goes to a gain account. It's just a gain on the income statement. It's just like any other revenue or expense account. It shows up on the income statement and it's closed to retained earnings. It's a one-time gain. Next, let's talk about $200. If we only get $200 for this treadmill desk, it's a debit to cash of $200. That's step 1. Step 2, we need to remove all traces of this asset from our books, so we do the same journal entries. We credit PP&E $350, debit accumulated depreciation $100. That removes it from our books. Next, we need to balance the journal entry. So we have $300 in debits and $350 in credits. We need another $50 in our debit column. So instead of a gain, this time it's going to be a loss. And this is the same as the gain account. It's like any other income statement account. It gets closed out to retained earnings. Let's just go through the official T accounts now. The PP&E T account. PP&E is an asset. It has a debit beginning balance. When we make purchases, we're debiting the PP&E account. For example, if we purchase something with cash, credit cash, debit PP&E. That's the debit to PP&E when we purchase something. When we dispose of these assets, well, we credit it. We take it out of the PP&E account. Maybe we get cash for it, so we debit cash and credit the PP&E account. There's that credit. So the PP&E account increases with purchases, decreases with the gross value of the disposed assets, and its ending balance will be a debit since it's an asset account. Next, the accumulated depreciation account. Accumulated depreciation is a contra asset. So it's in the asset section of the balance sheet, but it's got a credit normal balance. So its beginning balance is a credit. It's accumulating depreciation expense. So when we record more depreciation expense, it increases the account. When we record impairments, well, that's like accelerating depreciation. So it's like more depreciation expense. That also increases the account. And when we dispose of assets, we need to remove the accumulated depreciation from our books. And so that decreases the accumulated depreciation account. And it will end in a credit balance. Finally, let's go through Target as a real-world example. Here is an actual excerpt from Target's balance sheet, and they give you a lot of detail right there on the balance sheet. They give you the different categories of property and equipment accounts that they have. They have land, buildings and improvements, fixtures and equipment, computer hardware and software. Here they have software. That's an intangible asset, but it still counts as a long-lived asset. And they have construction in progress, things they're not done building yet. Finally, they'll have accumulated depreciation, which covers all of these accounts, and it's a credit balance. So this is a credit balance. That's why Target is showing it as a negative number, because it's a credit balance offsetting all of these debits. All of those accounts are debit balances. So you take all those gross book values, you reduce them with accumulated depreciation, and you end up with the net book value. Net book value and book value are interchangeable terms. So the book value of all of their property and equipment is $26.2 billion, since this balance sheet is in millions. That's how much property and equipment Target has on hand on February 1st, 2020. Now let's go to the Target footnote below the financial statements. They say property and equipment is depreciated using the straight line method. That's the same method we use. It's the same method almost all companies use to depreciate their long-lived assets. Here they give you the different useful lives that they use for different types of assets. So buildings and improvements, well, those last anywhere from 8 to 39 years. But the computer hardware and software, that only lasts 2 to 7 years. So they have different useful lives for different types of assets. And those will feed into that equation to calculate annual depreciation expense. Finally, they say this about impairments. We review long-lived assets for impairment when store performance expectations, events, or changes in circumstances indicate that the asset's carrying value might not be recoverable. We recognized impairment losses of $23 million during 2019. The impairment losses primarily resulted from store impairments and planned or completed store closures. They estimate their fair values, so they did the two-step impairment test. They need to compute undiscounted cash flows and discounted cash flows. How do they estimate those values? Well, they obtain market appraisals, valuations from third-party brokers, or other valuation techniques. Their impairments, so I taught you to record impairments in depreciation expense, which is fine. Lots of companies do that. Target chooses to put their impairments into selling, general, and administrative expenses, which is just a different line item on the same income statement as depreciation expense. So to recap, in this video, we learned about long-lived assets. We learned that they must have material value for us to capitalize them instead of just expensing them in the year that we acquire them. We learned that their useful life is greater than a year. Then we learned about depreciation expense. Depreciation expense is really just the systematic recognition of the asset's cost in the income statement over the useful life. What did it cost you to own that treadmill desk? Well, it costs us $100 a year to own the treadmill desk. That's what depreciation expense is meant to do. We learned about the impairment test, which is a two-step impairment test for PP&E and other long-lived assets. So it's the PP&E two-step test. And we learned about disposals, how if you get a different amount of cash from what the book value of the asset is, you'll be recognizing a gain or a loss in the income statement when you do the disposal.